Hello, everyone. Welcome to another episode of the Career Evangelist podcast. If you know this podcast, it's all about education. And what I try to do is to educate people with their money and their career. And today we are blessed to have a guest with us. We have Chris Miles with us today. With Chris today, we are going to be talking about passive income. Passive income is a sweet spot for me. I love to be able to build passive income and any education or anything that will help people to, build wealth. That is something that I'm very passionate about. So I'm very happy to welcome our guest today, Chris. Hey, Chris, welcome on the show.
Hey, thanks for having me, Bola. I'm really excited to be here today.
Awesome. So, Chris, if you don't mind, can you go ahead and introduce yourself to my audience? Let this community, let them get to know you better.
Yeah, obviously, if you guys have kind of seen my stuff around, I'm the anti-financial advisor, right? Which basically just means that I think financial advisors, for the most part, suck. And the reason I can say that is because I used to be one about 20 plus years ago. Now, I didn't always start out knowing about money. When I was raised by good parents that taught me good values. They taught me that your word is your bond. You do what you say you're going to do, right? They taught me about hard work. They taught me about following your passions and your dreams and things like that. But the one thing they didn't really teach me a lot about was money. Other than that, there wasn't enough of it, right? And if you've been raised like I was, it's always, you would hear phrases as kids growing up like, well, we can't afford this. Money doesn't grow on trees, What do you think I am, made of money? Those kind of things.
Yeah.
And even worse, I would hear my dad talk about his work, and he talked about how he would say, this job is going to kill me, like literally kill me. I'm going to die working, because he talked about all the stress that he had. And he even had strokes as early as his 40s, the age I am now. He was having his strokes and things like that. And that really impressed upon me that I didn't want to follow that same path. So when I went to college, I was planning on becoming a business consultant, but I figured if I'm going to do that, should I have real life business experience?
That's
So
right.
instead of just going through to get my MBA and everything in business consulting, I decided to drop out of college, just take a 1-year sabbatical. At least that's what it's supposed to be. Take a 1-year break and find a business, some business I can start, be an entrepreneur, get that hands-on experience, so then I have a better resume going into my MBA. Well, as I did that, the first business that came up that kind of intrigued me a bit was becoming a financial advisor, because I didn't know it was so easy to get in. I didn't realize that all you had to do is pass a test with 70% and not be a criminal, and you can become a financial advisor. And I could do both. I passed both those pretty easily. So anyways, so I started doing that, and I really enjoyed being on an entrepreneur path. I actually enjoyed it to the point where I never finished my degree, never went back. And but as I was starting to do that for several years, my dad then asked me to come see him. He said, Chris, when are you going to become my financial advisor? And so I went and sat down with him, flew back home. And as we were sitting at his table, he's showing me all of his numbers. He says, Chris, I'm 61 years old. I want to retire. What can I do? And I looked at everything, and he had been stuffing all of his money in his company 401k, right? Putting into the company retirement plan, getting his match and everything. He even paid off his house early. He paid it off in 18 years. Very proud that he was debt free. He did everything that Dave Ramsey would tell you to do, right?
That's awesome.
Yet, it's great. Yeah. He was the dream poster child for what financial advisors were looking for.
Right.
But when I looked at it, I said, Dad, I got to be honest. If you want to retire today, you better hope you die in 5 years, because that's how long your money's going to last you. Okay, Chris, that's not what I want to hear. What do I do?
Right.
I don't want to try to die in 5 years. That's not my plan. And I said, well, I don't know, because you did everything right. And that bugged me. It really bugged me, because I walked out not having an answer for my dad to help him become financially free. And remember, I believed as a financial advisor, I was helping people do that. And then I looked at the path, and I remember there's a real estate investor friend of mine that pointed it out to me. He said, Chris, well, how many of your clients are truly financially free where they don't worry about money? They don't worry about running out of it, for example. I said, well, none. They all worry about running out of money. And he said, well, great. Good job, Chris. Way to help no one. Well, how about this? How many of you guys as financial advisors are financially free not off the commissions you've been earning, but actually doing the investments, like the actual mutual fund investments you've been recommending. How many of you guys are able to retire? And as I thought about it, I realized there's guys that worked in my office since the late 1970s, and yet they couldn't retire either. And I said, none. There's your problem, Chris. Okay, well, what's the answer? And so that kind of led down a conversation eventually where I started to learn more about this alternative investment space, investing outside of Wall Street and more what people refer to as Main Street investing, things like real estate investing and things like that, that are actually backed up by assets, been proven to work, and actually had gotten people financially free. And eventually, after I started to go down that rabbit hole, I realized I can't stay as a financial advisor. I can't stay in integrity and keep teaching what I've been teaching for the last several years. And so I quit. I quit being a financial advisor in 2006, never went back. In fact, I vowed never to teach about money again, funny enough. I was just going to be a mortgage broker.
Here you are today talking
I know, here I am today, right? Like, that's the problem, because when you do it well, when you do it right, you get back to it. So that's the thing is like, you know, I was a mortgage broker. I was teaching ballroom dancing and doing stuff like that. But eventually, when I got myself out of the rat race, which was later that year, I was able to become financially independent where I didn't have to keep working anymore. It was an interesting space because I didn't know what I was going to do with my life, right? You never expect, especially for a guy who I thought if I just was really cheap, basically do what my dad did, right? Be really cheap, save up all my money in mutual funds, and maybe by the time I'm 40, if I save up a couple $1 million, I could finally retire myself. And funny enough, I didn't have to have a lot of money, and I was still able to retire myself at 28 years old back in 2006, and almost 29. And so I had to figure out what to do with my life. And of course, naturally, when you do something amazing, people want to know how you did it, right?
Absolutely, yeah.
And my real passion, my love, just like when I was teaching ballroom dancing, my love is teaching. And so eventually in 2007, I came out of retirement. I kind of came out to start teaching people how to do what I did, and teach people how to get out of the rat race and essentially apply what Rich Dad Poor Dad talks about, but never gives you the how-to. And that's kind of what we do today.
Oh, you know what, Chris? There's a lot to unpack from what you just said in the past 2 to 3 minutes. And, you know, when we scheduled this interview, I was thinking about talking about passive income, how people can generate passive income, which would also be a great topic. But now, thinking about financial advisor, thinking about the fact that many people are saving money, yet not many of them are confident that they can retire someday and never run out of money. That's a fact.
True.
I think we are going to shift a little bit and talk about financial advisor. But at the same time, I also know that many of my listeners, they would like to know how to start building their passive income portfolio. I'll also like to touch on that. But before we go into all that, you said you cannot save your money to build wealth. You also mentioned that there is an alternative investing path. Do you mind sharing with us that alternative investing path?
Yeah. So let me answer both questions and kind of transition them together, right? Because like I said, you can't really save, like you just paraphrased really nicely, you can't save your way to wealth.
Yeah.
And that's true because there's a lot of overpromise and under-delivering that's happening in the financial industry. I mean, funny enough, I was just speaking with a neighbor yesterday who's saying, yeah, I'm about ready to quit my job and start a business. And he's talked about how financial advisors really disappoint him and just the financial advising industry in general. And part of it's because they have all their little models and stuff. But the truth is financial advisors are really salesmen in suits. They're just salespeople. They are really hired by those financial companies, whether it's like your Goldman Sachs or Fidelities, right? Or whatever companies it might be. They're hired by those companies, educated by those companies to then pass on that education to you. That education is to benefit those companies. It helps make them more money, not necessarily make you a lot more money. And that's the big lie. It's kind of like pharmaceutical companies, right? When we start to realize, wait a minute, what are we being prescribed this because it's actually good for me, or because the doctor gets paid a little kickback referral fee for giving me that medication, right? It's the same thing. And it's hard to trust the financial advisors. Again, I fully believe financial advisors have a good heart for the most part. Most of them have good intentions and actually believe they can help people. But what I found out very quickly was when I started to look at the real rates of return of the stock market, like the S&P 500, right, which is starting to come back a little bit in 2023, I'm telling people, beware. This is when all the dumb money goes in the stock market, and that's when you lose the most money because it's about ready to crash. It's way overpriced. But people are thinking, oh, it's going up, so maybe I should just put money in. By the way, if you ever notice with a financial advisor, it's never a bad time to invest in stocks. Because if it goes up, they say, well, buy more. But if it goes down, they say, well, buy more now because it's going on sale.
Yeah.
Right? Like
Yeah.
dollar cost average, which is dumb because they're trying to help you. Basically, they're trying to help you to find a dumb way to not, to essentially buy low, sell high randomly. Right. But the truth is, if the market's going up all the time, you're buying more expensive all the time. Why would I want to buy it when it's going up? Financial advisor, if you're really that good, why don't you tell me when the market's going to crash? I buy at the bottom, and that's the only time I buy. That's
right.
what it should be like.
Mm-hmm.
That's not the advice they give. It's always a good time to buy. And the stock market, which, by the way, over the last 30 years has only averaged roughly about 7.7%. That's the actual average yield of the S&P 500. 7.7, not 10, not 12. So when I would put numbers in the models, like as a financial advisor, we put in like 10, 12%, right? Well, the problem is the S&P 500 has never done 10 or 12% for a prolonged period of time, not more than 20 years, especially. Well, if that's the truth, we're already getting numbers that aren't going to be true in the first place. On top of that, most mutual funds, over 90% of mutual funds, do worse than the S&P 500. I just did a podcast on my Money Ripples podcast show recently where I showed Fidelity, all there's 401k funds that you can pick from. And right now, millennials are picking 80% of the time, they're picking the target date funds, which means if you expect to retire in the year 2055, you pick the 2055 fund. It's so easy. It's brainless. You don't have to think, right? You just put your money in and just whatever date I want to retire, that's it. Now I can retire. Well, the problem is that target date fund is doing more than 2% worse than the stock market. So do the math, especially when you have the fees coming out. There's a 0.75% fee. So it's almost 3% worse than the stock market's been doing for the last 10 years. So think about it. Do the math. If the market's average about, say, 7.7%, well, let's just say that the total, it's doing 2.7% worse than the market average. That means you're only making 5% a year. Try putting that in the calculator and you'll realize you're never going to be able to retire. And that's exactly what baby boomers have been finding out already. And what us Generation Xers are starting to find out too, is that it's not enough. And they'll blame us for not putting enough money in, but it's not our fault. It's because we were sold something that can't even perform the way that they say it will perform. So that's the problem I see, is that you can never, even with the 401k match, if you get a match from your employer, it only adds long-term 2% at most, maybe 3%. That's if you just do the match. If those that max fund their policies, or not the max fund their 401ks and things like that, they only maybe make an extra 1.5% average over time, compounding over time. So if you make 5% and you try to max fund your 401k, well, guess what? You might make 6.5% if you're lucky, long term. Still not enough to ever get you to be financially free, especially with inflation, right? So that's where alternative investments come in, because the thing that I learned that I didn't know as a financial advisor was that there's investments you can make 10+% returns. And it's not just based on growth like you get, because remember, even if you happen to save up over $1 million in your 401ks or IRAs, you're only told to pull out 3% a year. That's the new number. The 4% a year, it's been done for years. That's a myth now. That's old news. So if you pull out 3% a year on $1 million, that means you're living on $30,000 a year. That's poverty level as a millionaire. That's why I was trying to get up to $2 million so I can live on $60,000 a year, because 20 years ago, $60,000 a year, $5,000 a month sounded like a lot.
Well,
not so much anymore after inflation, right?
Yeah.
So that didn't even work for me. But that's the problem with financial advising. They do that because they know that once you go into retirement, you can't make that much money anymore. Some will still say, put your money in mutual funds, but that's not a good idea, because if you put your money all in the stock market, you could also lose a lot of money, especially when you pull money out. So when I started to realize there's this whole other world in the real estate game, for example, there are rental properties that we can buy that I don't manage. They call them turnkey real estate properties, right? Where you turn over the property management to somebody else. They help you find the property, they help you buy it, and then they will property manage it for you. And then you just have to collect the rent. right? You still have to manage the property manager, so to speak, right? But you're really hands off. You're not dealing with tenants. In fact, I don't even know my tenants' names. I have to go look up the paperwork to see what the last lease renewal when we raised the rent on them again last year, right? Like I had to look that up. But that's the cool thing is that I don't have to deal with the tenants at all, but I can sometimes make at least a 10% what they call cash on cash return, meaning that if I put $100,000 in that property, I'm making about $10,000 a year profit after paying the property manager and everything. Man, think about it. If you can even make 10% on that same $1 million, remember that $1 million we can only pull out 30,000 a year in a retirement plan. By the way, I had a client that did this, Dan, who was on my podcast recently. He talked about this. He had $1 million from his retirement plan. He wanted to make more than 30,000 a year. So he came to work with us. And what ended up happening is that now between him getting it, a little bit on the rental side, but he also invested in some apartment buildings. And then he's also invested in like oil and gas and things like that. Some things that pay you double-digit returns. He's right now making an average of about $11,000 a month from that $1 million. Not 30,000 or 2,500 a month, but 11,000 a month, or about 130,000 a year. So he's making 100,000 a year more with the same money. And that's what got me excited when I quit being a financial advisor. It's like, in fact, that's what got me to quit, because I realized there was a better way to do it. There's another way to do it and still have real assets backing it up. Stocks, I can't control stocks. I don't even know if it's even going to be worth something the next day. I mean, we already hear about Tesla being overvalued by 100 times on its stock price. That's tremendously crazy to buy Tesla right now. But if that comes crashing down, what's that do to your stock portfolio? You're losing money, right? So to have real assets that are more stable, been proven to work over time, made more millionaires, I think that's a better way to go.
Awesome. So I invest in the stock market, by the way, full disclosure here. I think what you are saying is that there's an alternative, and you spoke about real estate investing. You talked about oil and gas investment as well. I'm thinking maybe for people drilling for oil, maybe that's what you are talking about. I want you to break it down for us. If someone is out there today that want to start building their passive portfolio, you spoke about your friend Dan that came to work with you. What would you advise this person, or what steps will you tell them to take if they want to consider the alternative that's outside of the mainstream stock market?
Yeah. So after I already tell them, get lean, get liquid, and get out, like find the cash we can use. It depends on the money. It depends on their situation. If they're consider what's called an accredited investor versus a non-accredited investor. Just so you know, accredited investor just means that you have either one, as a single person, you make at least 200,000 a year income for the last 2 years, or 300,000 as a couple, and or two, you have at least $1 million in net worth, not including your home equity, because home equity doesn't count. But everything else, if you have more assets, then you're an accredited investor. That opens up all kinds of options. But let me just talk about some of these options in general, right? Because some of them apply, some of them don't, if you're accredited versus non-accredited. I already mentioned turnkey rentals, which is that's one of the safer ways to go, even though lately with interest rates, they haven't been as good if you're trying to buy with mortgages and things like that. But I'll tell you, I mean, I bought a property 5 years ago that in total, with the cash that I put down, which was only $32,000 after closing costs, I've made well over $100,000 from that money. I've basically made a 300% return on that rental, and that's with the rents coming in and everything. Even if I didn't have appreciation, I still made over 100% in the last 5 years. That's better than the stock market, right? And I've done that with tax advantages too. So that's one way to do it. There's also different things called syndications. Now, syndications are when you pool your money with other investors to buy a specific type of project. This could be like an apartment building. This could be self-storage units, buying like a complex for self-storage. This could be something like, like I mentioned, like the oil and gas. Now, I would say stay away from the more speculative, like the drilling stuff, because I'm glad you brought that up, because there are different aspects you can, just like in real estate, there's different things you can do in oil and gas. Drilling is a little bit more speculative. I tend to stay away from speculative stuff. I'm very, very low risk. Funny thing is when people tell me, well, I'm a conservative investor, I put my money in the 401k. No, you're not. You're risky. If you put your money in mutual funds, you're way riskier than I am. You're aggressive. You're a risk taker. I'm not a risk taker. I don't like that stuff. I just put play money in those areas, like crypto and stocks. Yeah. I just play with it. If I lose it all, it doesn't hurt me. but I like things that are backed by real assets. So like with real estate, I like it where they pay you a lease for the land and they pay you mineral rights or royalties on the drilling they do too. So you get paid twice. It's so we're more doing a mineral rights type of partnership, business partnership that way. So that's one thing you could do too. There's also things like raw land. You can actually do things. I have a partnership. I don't do any of the transacting. By the way, I'm very passive, hands off. I don't do any of this actively. Like some people will tell you where they say they get passive income, but really they're just full-time investors, with a full-time job. I'm very passive. I have other people do all the work. So like raw land, I have a partnership where we split it. I finance it. They do all the work. And I'm a 70% partner. They're 30%. And right now, I'm making from over 250,000 invested, actually not even 250,000, about 220,000 invested. I'm making about $7,400 a month off of that. So, you do the math. That's pretty close to almost 90,000 a year off of 220,000, right? So very good returns with that. Not guaranteed, of course. Results may vary, right? But but it's been pretty consistent, not just with me, but some of my clients as well. Some of my clients do better than I do on my own investments, because like, for example, one of the oil and gas ones, the mineral rights ones, I got paid, like a little over 8% last year on that one, on the first year of production. Some of my own clients on the next deal that with that same company made over 35% last year, right? So it's like, well, dang, you guys just beat me. My own clients are making more money than me from some of the same investments, so it just kind of depends. But that's the cool thing. There's so many options. There's even franchises you can buy that are more hands-off. A little bit, I would definitely not call those passive. They're more semi-active, or you might have to be part-time in it, but it could be part-time work that could generate 100,000 plus a year for you, in profit. So there's just so many ways. When you realize the alternative investment space, there's so many things outside of Wall Street that you can do that really, when you look at Wall Street saying, wow, this is high risk in Wall Street with mediocre returns, really lackluster returns, I'd rather get lower risk with higher returns and more cash flow, more income coming in that allows my money to work harder for me, so I don't have to work so hard for it.
Oh, that's good, Chris. So you said maybe I should put it this way. There are people out there today that may want to start investing, but maybe they do not have the cash. And I know you said you have a secret. In fact, you have 7 secrets to free up cash right now, so that people can have access to cash. So Chris, if you don't mind, maybe you can share 1 or 2 secrets with us so that people can learn and know how to free up some cash so that they can start investing. What are those secrets?
Absolutely. Yeah, I know we only have a few minutes, so I'll be brief with it. If you want to see the full list, you can just go to moneyripples.com, and we've got a free ebook on there called Beyond Rice and Beans: 7 Secrets to Free Up Cash Today. That's on there. The first one I always recommend with one of those secrets is start tracking your money. Don't worry about budgets. Forget about budgets. Just start tracking your money. Start by looking at how much money's coming in, income, as well as expenses going out, and start to just track it. And then decide, are these productive expenses? Or are they destructive? Like I had one client where like he was seriously spending $600 a month on alcohol, and he put his consumptive expense. His wife put it as destructive, and she's like, no, that alcohol consumption is too much. Yeah. And he said, yeah, okay, it's probably not. It probably is a little bit destructive to our relationship. And so I said, listen, you don't have to cut off alcohol and go dry. You can. Why don't we lower this to $200 a month instead of $600? What if we do that? Okay, cool. Well, that's $400 a month right there. I had one lady where they were making $250,000 a year between her and her husband, and they were paycheck to paycheck. Found out they were spending $5,600 a month eating out, $5,600 a month just eating out, not including groceries. They were spending over $1,000 a month on groceries. After we got them to track their money, but then start to say, well, let's cut the eating out budget to only, quote unquote, $1,000 a month. I know many people love $1,000 a month budget for eating out, but again, I don't want people to cut it hardcore, because I don't believe in scarcity and living on rice and beans. I think that's dumb. I think what you should be doing is enjoying your life, but put your money in places that you actually enjoy. And so for them, it's like, well, let's start working backwards. We end up freeing up total that year between that and some tax savings. That's another thing. Taxes, if you have a business, lots of things you can do there. Between that and some tax savings, we saved them over $70,000 that year. That's so awesome. Think about it. They were making $250,000 a year, $70,000 back in their life. They were no longer paycheck to paycheck anymore.
That's
Now
clear.
they were actually thriving.
Wow.
So that's one way to do it too. Debt's interesting. Don't worry about the interest rate so much. I tell people ignore the interest rate. Focus on what I refer to as called the cash flow index. Cash flow index is simply this. You take the balance of the loan that you have, an individual loan, and divide it by its minimum monthly payment, and you'll get a number. So for example, say that you have a $10,000 credit card, that's $200 a month. You divide those into each other, you get an index of 50. But say also you have a $10,000 car loan, that's $500 a month, which is more stressful, right? Because what I've noticed is that it's the payment that stresses people out, not the amount you owe. It's the payment, the monthly outflow, right? That's what's important. So of course, if you had 10,000 bucks between a $10,000 credit card at $200 a month or a $10,000 car loan at $500 a month, if all you had was 10,000 bucks, I would pay off the car. Free up that 500 because you always put the 500 to the credit card, paid off in less than a year anyways. Hardly charge you any more in interest. Because interest, by the way, that's long term that people, they freak you out with. Short term hardly does anything to you. But that 500, so do the math. 10,000 divided by 500 is a 20. That means the lowest cash flow index you want to pay off first, especially if it's below a 40. So if you pay off the lowest cash flow index first and then do that snowball method by paying each one as you go up the number order, and I usually stop paying them off when it gets above 50 or so, depending on the loan. I stop paying them off. Here's a pro tip here. If you have a car loan that's low interest or a mortgage or things like that, wait till the index gets below a 20, including student loans. Wait till it gets below a 20 before you try to pay it off and pay them off at once, one big check.
I like that. Thank you very much, Chris, for sharing these tips with us. The information you've given to us today, they are very powerful and invaluable. So we appreciate that. Right behind you there, I know this is a podcast, but I also have a video that I upload on YouTube. I like what you have. You said, live your life now, not tomorrow. That's very important. I also always encourage my listeners to find a way to enjoy their life, have fun, and stress less. So I also want to give you the opportunity to motivate people, especially maybe those that are living paycheck to paycheck today, maybe those that are drowned in debt. Maybe in 1 or 2 minutes, what can you tell them to motivate them that they too can attain that financial independence status?
I'll tell you, if I can do it, anybody can do it. Because at my worst, my financial low, I was over $1 million in debt, and I was short $15,000 a month.
Wow.
That was my worst time in my life. And it was a long battle. So, I mean, think about it. I was $1 million more broke than the homeless guy on the street. So
wow. Yeah.
They were $1 million richer than I was. And I didn't go bankrupt. I did pay that debt back very slowly over time. And it took me a good 9 years from that low point to be able to become financially independent. That's actually where I became independent the second time when I was 39 years old. But I'll tell you, if I can get through that kind of situation, anybody can. And that's really what got me to coaching so many clients in the first place over the last really 13 plus years, is because I knew their situation wasn't as bad as mine. We can help anybody, be able to create that financial freedom and independence.
Thank you. I like that. So where can my audience, where can they find you so that they can continue to learn and be in your orbit?
Yeah, like I mentioned earlier, you can follow our Money Ripples podcast on YouTube or iTunes or wherever you consume podcasts, or you can go to moneyripples.com.
And there you have it. Thank you very much, Chris, for joining us on the show today. Hey, people, if you want to really build wealth, sustainable wealth, you've got to find ways to generate passive income so you can make money even while you are sleeping. Thank you, Chris, for coming on the show today. We appreciate your wealth of wisdom.
Thank you.